The yield curve has had quite a significant inversion. Yes, it's inverted. Yes, every recession has been preceded by an inversion, but not every inversion causes a recession. I'm not necessarily worried about the fact that there was an inversion, and that's not even the main thing I'm worried about. I'm just bringing it up because everyone knows about it, everyone talks about it, and there was one particular thing that I was kind of noticing today. So the inversion officially occurred today. Earlier this week, we got close to it, but the spread was very close most of the week. It was, 0.02%, 2 basis points, whatever, very, very tight. And today, it got pretty extreme, double or triple that at one point. So today, it looked like we saw a little bit of a capitulation with regards to the inversion. But again, over here, we focus on fundamentals. And while there may be some fundamentals behind that, and obviously the bond market is driven heavily by fundamentals, it's not the number one thing I'm concerned about. What I'm concerned about is the economy, and more specifically, decreasing hiring, decreasing labor spend. Earlier this week, I'd seen various articles. Chamath posted a thread of things he read. There were a number of articles in there about tech companies that were decreasing hiring. I kind of looked at that and said, all right, that's a few of them. Obviously I thought about that, but wasn't too worried about it. We got some good, strong jobs data today. That was good in that department. We've been very fortunate to have a strong jobs market. It's kept this economy afloat, I would argue. And I think we've got too comfortable with that. And we can really see some surprise there. And the thing that is putting me on edge is the fact that Netflix, a large company that produces a lot of money, that has no capital issues, telling their employees to slow down and be cautious about hiring. The reason why I'm concerned is because I don't think we're over with that. I think this notion might begin to pick up steam a little bit. Obviously, I don't know, but I'm trying to get ahead of it and forecast a little bit. So I'm making adjustments. I think this could be quite a concerning thing if job growth stalls or possibly reverses, and we get a bunch of companies that have a lot of money because they did stuff in the equity markets, and there's a correction there, aka yields rise, companies can't raise capital as much, they can't borrow as much, and they're trying to turn the clock down on hiring. That is not an ideal mix. That is a situation that can very much reverse. And considering the market is just roughly 5% away from all-time highs, I decided to adapt for this newfound fear. I'm not necessarily concerned about reaping every second of the rally. Yes, I have certainly reaped the rally. You can see my performance on Twitter. It's right there and pinned. But I am making adjustments today after seeing that Netflix news. I'd done very little trades today, just added some silver calls that were, long-term silver calls. And then after I saw that Netflix thing, I decided to raise an additional 5% cash. So that brought me from roughly 15% to roughly 20% cash. Quite a solid cash position. And I added some additional SPY May 20 puts. I could have gone out farther, but they get pretty expensive. I think this is a pretty good range. They are 435 strikes. I have also May 20th 420 strikes. Those are very cheap right now. Not saying you should buy them. Risk tolerance, that's yours to determine. But I am putting the hedges on. I am getting ready for some turmoil because, like I said, 5% away from all-time highs. And the Fed. Let's not lose sight of the Fed. There was a saying the past 2 years that allowed the market to continue to rally. And that was that bad news is good news. That we get bad news, the Fed is going to become easier or is going to delay tightening. They are now in a position where they can't delay tightening. It's either they can tighten at a reasonable and predictable pace or they can tighten faster. I don't know how great that is, tighten faster. But today we got good jobs data. I know I said I'm concerned about jobs data, but good jobs data now means right after now maybe the Fed does the 50 basis point. And it seems like that is the move that people are discussing now. 50 basis point seems pretty certain. If I remember correctly, the assumption was after the last time the Fed spoke, and that caused this quite strong market rally, the assumption was the Fed was going to do 25 basis points at every meeting. Now people are saying 50 basis point pretty much guaranteed at the next meeting, 50 basis point probable at the next meeting after that. Hold on. 5% away from all-time highs? I think that's a little much. I'm adjusting accordingly. I don't know what's going to happen. We're going to have to find out. But I am getting a little concerned and I'm a little worried, and it's based in fundamentals. So I am adjusting accordingly. Now, what am I long? Because 20% cash, well, that's 80% long. I still like my favorite 10x growth stocks that I think are at rock bottom or just a little bit off rock bottom, still down maybe 70 or 80%. Still the same numbers we were talking about right before that day the Fed was talking, and we were saying be greedy when others are fearful, and we had been saying before that, before the bottom. So I still like these companies, and actually they seem to be my favorite ones that I talk about on this channel, outperforming today quite meaningfully. Editas was up like 8-9% at one point. That's a strong move. Not saying I expect that move to continue. Not saying that move isn't gonna, hit some turbulence if there's a market pullback. But that stock is well priced, and I'm happy to own it because I'm owning it as an investor. I am long. I'm not trading it. I'm not in and out. I've owned this stock for over 2 years. I'm gonna continue to hold it. And I'm going to sell it if it gets ridiculously priced. If it gets to $80 a share, I'll probably take some off the table. If it gets to $10 a share, I'll probably add some more again, even though my position is around 5%, which is one of my larger positions. I have that. I have Jumia, which we've made videos about on this channel. I think these are cheap stocks. I like owning the largest online retailer in Africa for less than $1 billion when its most appropriate comp is Mercado Libre at roughly $59 billion. 59x. Just because it's Africa over South America, fine, I get it. South America is a more mature market. I'll take it because I want the growth. I'm playing some growth, okay? I want some businesses that are going to grow. But I'm also worried about some things. So, hope that made sense to you. That's today's video. Let me tell you what I sold to raise that 5% cash before I go. Boeing and my beloved, because I love Dave Portnoy, and this is not any sort of opinion against him, but Penn National Gaming I sold simply because I think it is a more economic sensitive stock, and I'm a little concerned about that. So I just felt like those were the two most appropriate places to raise cash given my concerns. So that's today's video, and I plan on getting back into Penn National Gaming in the future. Once I feel a little bit better, I'll get back in. Boeing, less certain I'm going to get back in. Penn National Gaming, Barstool, that's a company I want to be an investor in. But in a period where I'm a little concerned, I'm going to raise a little bit of cash. That's just how I roll. So that's today's video. And until next time, peace out.